So first of all, we wanted to introduce a typical private equity business model or a venture capital business model, which is very similar. Usually, private equity funds aim to acquire company stakes with a 3 to 7 year exit strategy. So let's see the diagram on the right. So we have limited partners. We have a lot of different limited partners. Well, not a lot, but just a few. They will invest capital to the private equities. So these guys are called limited partners, and the private equity or the venture capital who are actually going to run this funds, different funds, will be called general partners, the GPs. So I've seen some of my students who thought that the GPs invest with their own money. Well, it is true in some cases, but in most cases, the GPs, the private equities, receive capital from the LPs, who are usually pension funds, insurance companies, banks, etc. Usually people or organizations with a lot of money to handle. And of course, these players also do invest directly on their own, but they have so many to invest that some of it they plan to invest indirectly via the GPs. So these GPs can be private equities, hedge funds, all sorts of funds. Private equities receive the capital from the LPs and they make investments. But different from ordinary asset management companies or hedge funds or something, private equities usually invest, acquire companies, acquire a majority stake or at least a very large stake for a relatively longer time period. And the technique that they use upon investing in these targets are called leverage buyout techniques, which will be our main topic of this course. Once the investment makes profit, the original principal will be returned to the LPs, in addition to 80% of the profits. The rest of the profits will be distributed to the general partners. So for example, if the GPs made a $100 million profit, 80 will go to the LPs and 20 will be the GPs' returns. In addition, the LPs will pay the GPs approximately 2% as a management fee. So this is regardless of whether or not the GPs make profit. So for example, if the GPs invested $100 for target A, the GPs will receive annually $2 of management fees annually. If the $100 investment makes a 20% profit, that's a profit worth $20. 20% of it will be the GP's return. So that's approximately $4, and the GPs in total will be receiving $6 in total. So that's the typical private equity business model. Of course, this 2% or 20%, these numbers can vary by the fund size or country or market situations and etc. But yes, we're hearing that as more and more fund managers enter and the private equity market expanding, these fees are gradually decreasing.